James, thanks so much for joining. So your numbers this quarter, closing out your most profitable year in a decade. You've defended your market share in fixed income as well. Of course, the fourth quarter, difficult for FICC trading as it was globally, but even with your 14% decline, that's still an outperformance versus Wall Street. So given that outperformance and what you've seen so far this month, the start of this year, what is your outlook for 2022?
Yeah. Well, look, looking back on 21, we were very pleased with the momentum in our businesses. As you say, we've been slowly recapturing market share across both origination and advisory and our FICC business. So in the quarter, origination and advisory was up 29%, FICC down 14%. And as you say, both of those results are in line with or perhaps a little bit better than some of the peer averages. So we continued, I think, to at least hold, if not gain market share against what was for us a relatively strong fourth quarter of 2020. Now, going into 2022, as you ask, we're actually seeing similar momentum. The markets, of course, have been disrupted in the first few weeks of the year. We feel that we've navigated that reasonably well. We're actually doing a little better than where we were last year. And we continue to see the client momentum we had late last year. There may be, as there always is, a bit of a pullback in the corporate finance area as CEOs and issuers adjust to more volatile markets. But our sense is that we'll navigate through that as well.
Yeah, disrupted, volatile, definitely feeling that throughout these markets. Now, at the same time, yesterday, you announced a share buyback for last year, 700 million euros. Of course, this is the first buyback and dividends you're starting to announce into this market as part of your 5 billion euro plan. Can you give us more of a sense of the timeline for that plan? What can future announcements look like?
It's too early, I'm afraid, Dani, to offer more of the forward guidance. We'll talk more about it at an investor day we have on March 10th. But we feel like the 700 million capital return, which breaks into 400 million of dividends and 300 of a share repurchase, is an important first step in delivering on our promise, as you say, to return 5 billion of capital to shareholders over time. It's an important milestone in the transformation of our bank that we commenced back in July of 19.
Fair enough. Is it fair, though, if I can just push you on that a bit, to look at the 700 million as an annual threshold from here on out?
Well, look, we certainly would want to grow the dividend from here, and that's an important part of our return profile. And we think that share repurchases are an important part of that overall return, given if you like, the powerful corporate finance benefits of being able to repurchase shares at relatively low, multiples of book value and earnings. So we think that that's a very powerful combination.
So the industry right now, James, is in the middle of this war for talent. It's really visible, whether it be here in Europe or in Wall Street as well. Now, you have 3 decades of experience in the industry. What you've seen over the past year, how would you characterize the scale and scope of Deutsche Bank's competition for talent?
Well, look, it is a war for talent. There's no question. We've seen pressures on our workforce in a variety of ways. We're working hard to ensure we remain competitive in our ability to compensate our employees. We're working hard to be a great place to work as well and to unfold professional opportunities for our employees. We actually had a very successful year in 2021 attracting people to Deutsche Bank. And I think the momentum that the firm has plays itself out in that war for talent. We're determined to remain competitive, to continue building our businesses. And obviously, that's had some impact on our expenses, as we've seen also with peers.
Right. And of course, this quarter, a slight miss on costs as well. So given that, how do you contain costs, again, as you have to pay up more to make sure you stay competitive in this environment?
Yeah, it's absolutely a pressure on the cost base. And in this quarter, it was one of the factors that drove expenses a little higher than we'd initially guided. We think that on balance, the fourth quarter results show continued discipline in face of some of those pressures. And against the outstanding revenue performance, we were able to deliver really most of that revenue outperformance to the bottom line. Going forward, we obviously need to be very mindful and vigilant of managing our cost base, not just the compensation costs, but all of our costs. We intend to do that. We have ambitious programs underway. And look, the more we can do in the rest of our cost base, the more flexibility we buy ourselves to ensure we can remain competitive in that war for talent, competitive on compensation for our employees.
2022 is also a milestone for Deutsche Bank in that it's the final year of your 4-year turnaround program. You're set to unveil a new strategy in March. I won't ask you what that is because I realize we are still a ways away from March. But can you give us any sense of what M&A, what mergers and acquisitions, what role that will have in your new strategy going forward?
Look, it's really too early. You know, we've I think been consistent with our messaging that we've been working on the transformation of Deutsche Bank, that we think that transformation will position us much better than where we were a few years ago to participate in it. But as you'd expect, you'll hear from us on March 10th more about the continuation of our strategy, how we intend to grow on the base that we've built through that transformation. We think we're well positioned, and I have to say, the transformation progress that we've made since July 2019, in my judgment, is just remarkable in the last 2.5 years. We have one more year of hard work ahead of us, but we think that the company will be in a unrecognizably different place.
Not front-running your March announcement. Totally get it, James. We also had yesterday a Fed decision. Of course, your peers, very sensitive to rates as well. Some of your peers in the U.S. have said that they expect the Fed to hike 7 times this year. Jay Powell yesterday left the door open to it. Of course, this affects your business greatly, what global yields do. What are your expectations for how the Fed acts, how tight we should expect monetary policy to be?
Well, look, you know, and our economists do excellent work. Our house view has been for some time that the central banks were behind the inflation wave, and that the transitory would not be quite as transitory. And hence, you're seeing a reasonably dramatic shift in the monetary policy environment. We may see more of that actually even in Europe than had initially been anticipated. We do, therefore, expect rate hikes and qualitative tightening this year. As you say, Dani, it's beneficial by and large to the banks. We obviously need to work through the volatility that arises whenever there's a monetary policy shift. But there's significant interest rate and possibly also upside beyond that in our business going forward.
James, you mentioned Europe. I mean, could we see surprise tightening, surprise moves from the ECB?
Well, our economists on Monday called for the first move to be before the end of the year on the deposit rate, which is ahead of where the market is by far. And in their judgment, it's simply a recognition of the likely persistence of inflation, although it will moderate this year, we think, relative to 2021 as conditions normalize somewhat. The fact that inflation will have lasted longer, and it'll give, in a sense, the ECB an opportunity to begin to normalize the monetary policy environment. That's the call of our economists, certainly something that would benefit our business. But we also think that it's healthy for an economy to end what has been a relatively long-standing sort of condition of negative interest rates. I think we'd all see that as an unnatural condition, and one that we would look forward to a normalization in respect of.
James, just one more question for me before I let you go. The ECB publishes its climate stress test today. How prepared is Deutsche Bank to take on this challenge, again, of the climate stress test?
Look, we think we're reasonably well prepared. As you know, it's an emerging field, frankly, and one that we and all of our peers are investing a lot of effort to develop new models, new ways of thinking about how climate change can affect our portfolios, and of course how we can act in a way that furthers the sustainability agenda in the society. So we're investing resources, and in some ways it's a voyage of discovery now, building on the work that we and others have done in other stress tests in the past. But we think this exercise will be a very useful learning exercise, both for the banks and for the supervisors.
James, thank you so much. Really appreciate your time this morning on what I know is a marathon of a day. So thank you so much. Congratulations on the results,
Thank you, Dani.
and good luck to you for the rest of the day.
Pleasure to be with you.